Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly update on the Australian economy and the housing market with our friend Martin North. How are you, Martin?
Very good. How are you going?
Very good, thanks. You've been very busy as always over at Digital Finance Analytics. You're getting lots of mainstream interviews and stuff, which is great to see. So how's that all been lately?
Yeah, pretty good. A lot of going on. And I think as the housing market begins to decay further and as the people realize that this is probably more significant than was originally recognized, more people are knocking on my door saying, what do you think? So I'm happy to share my thoughts.
Exactly. So let's get in and check out our top 10 data points. And the first one we've got today is credit growth, which is still easing, but 4% is a lot higher than what people are maybe realizing.
Yeah, so this is from the Reserve Bank. This is their monthly credit aggregate data. And yes, the overall lending is still growing at 4% per annum. But it's still positive, right? Now, within that, owner-occupied lending is 5.7% and investor lending is much lower and business lending is okay. But the point isn't, people lose sight of this. It's not like the lending tide is going out. It's just growing at a slower rate. But as we've discussed several times, the credit impulse, which is the rate of change, is the thing that fundamentally drives home prices. So as long as the rate of change slows, home prices will go on falling.
So, Martin, in Ireland or in the US, when they had their big housing downturns, was that number still positive, the rate of credit growth, or did it turn negative?
It did turn negative, but very late in the cycle.
Yeah, okay. So it's still telling us that we're fairly early on seeing house prices go down.
Yeah, and you'll see there's a slide later that Steve Keen did that shows where we are relative to the UF cycle, right? Which is quite interesting because we are not yet through this process.
Fantastic. So next up, we've got the non-banks, and we know the Royal Commission has got everyone thinking a little bit. So talk to us about how that lending has changed.
Yeah, so this slide shows you both the main bank numbers, which is the same as on the previous one, but also the non-bank share. And the non-banks are people who don't take deposits and are often funded from securitization or indeed from private investors. And they're making hay at the moment. So their growth, is 14% growth per annum for owner-occupied lending and slightly lower for investor lending, but they're way higher than for the main banks. And so what we're seeing at the moment is a leakage of lending from the main banking system into the shadow banking system, into the non-bank system, which is poorly regulated, where they can charge more and where, frankly, the risks are probably higher. And it's the same as in the US. Prior to the GFC, towards the end of the cycle, the non-banks grew a lot faster than the main banks. So we're seeing that play out the same here now.
And this is people having their hand forced, really, when they go to refinance and being told no, and they have to go to the shadowy areas, I guess.
Well, that's right. So many people with interest-only loans couldn't get a refinance loan with the main bank, but guess what? Some of the non-banks will do it. But of course, they pay high interest rates as a result, and that's all part of the pressure on households.
Exactly right. We'll talk about rate cuts later maybe as well. Next up here, we've got bank funding, and we've spoken about how this gap widened and then narrowed, but it's since it continued even more so.
Yeah, so this is now in negative territory. So compared with last year, the funding costs are now much, much better for the banks. So expect to see more cheap offers for new loans. I don't, though, expect to see this translate to rate cuts for the back book because all the banks are in their last reporting season are all reporting margin compression because of the historic impact of the higher funding costs. But now we're in the situation where bank funding costs are continuing to drive lower. So expect even more lower rates for new borrowers.
And Martin, I'm definitely of the opinion that we're going to see a rate cut pretty soon. So how much of that do you think the banks would pass on, and how does that affect that spread?
Yeah, so I think you are right. There will be a rate cut. The question is, when is it? Next month or is it August? The question then will be how much of it will be passed on. And my own view is the banks will pass on some, but not all. The reason for that is we're getting close to what I call the zero bounds problem, which is essentially that as interest rates approach zero, the margins the banks can manage between the deposit side of the ledger and the loan side of the ledger gets narrower and narrower. So it will be highly unlikely, in my mind, that if the Reserve Bank cut by 25 basis points, all 25 basis points would flow to borrowers. And indeed, the banks might choose to hold some of that back to subsidize cheap loans to attract new loans again, which is the same old, same old. So, yeah, my view is that if the Reserve Bank cut, wouldn't have a huge impact on mortgage rates.
And this has a wider discussion around it as well, around how beneficial for the economy and for households is even cutting rates at this sort of late stage.
Yeah, it gets to the point where, you can cut and have no real difference, right? And, the Reserve Bank has said they're happy to cut rates and they're happy to do quantitative easing if they need to try and help the cycle through. But experience around the world suggests that as you approach this zero bounds, then the benefits of doing it get less and less and less. And we're probably at the point now where it's very marginal.
It's the same with the reserve requirement of 7.2%, the benchmark, and they're talking about maybe cutting it down to 6.75. Realistically, is that going to make a lot of difference?
Yeah, so this is effectively the benchmark rate that's used when you're assessing a new loan applicant, right? So let's assume the rate is at 7.25% rather than the current rate. Can they still afford to repay it? And there's been heavy pressure from the mortgage industry and from lenders and other players to say, drop that, because that's way above the current rate. But APRA has been quite clear that they're unlikely to do that because they think that's actually a prudent rate. And that's an average over the long term, by the way. So, there's some rationale for it. But even if they did drop it down, it's only for new loans. It doesn't impact existing borrowers at all. And as we know, the volume of new loans is way down. So I don't think dropping it slightly, let's say 50 basis points, is going to fundamentally turn the market around. So my view is interest rate levers or the benchmark rate levers, neither of them are very strong.
Yeah, and I only sidetracked to talk about this because I actually saw some of the housing analysts and channels I follow begging them to cut this measure, and it's getting crazy what they're trying to do to prop it up.
It's desperation stakes, right? So people are now realizing that property prices are continuing on their way down, and that the voices to try and turn it around are getting louder and louder. But frankly, they're shouting in the wind, I think.
Yeah, we better move on, Martin, to our next point, which is that household confidence, and no surprises here that this is continuing to trend lower.
Yeah, so this is based on our household survey data just out yesterday. And unfortunately, the overall index is down to a historic low now. It's actually down below the previous one. And again, we're finding all three of our wealth segments, those without mortgages, those who are renters, and those with mortgages, they're all less buoyant than they were. And it's because of the fact that incomes are not growing, costs of living are rising, people are worried about their job security, and their net worth is decaying because property prices are falling. So all of those things flow into financial confidence. But this is a leading indicator because if people are less confident, they're going to actually spend less at the shops and hunker down, all those things. And so this is just saying we're going to see more of this ahead, I think.
Yeah, and if we see renting ticking up a little bit, that's sort of a sign of overall sentiment that the general public perception is that house prices are going to go down, and that's probably going to bring down rents for those people as well.
Well, rents have dropped 3% in Sydney in recent times. And in fact, I've got a few people in my channel who've sold their property a few months back and are now renting and are, benefiting from lower rents and the capital that they release from their property. I think that may be a scenario we're going to see more of.
And it's very common to rent in a lot of other countries, which we touched on in our documentary as well. Yeah.
Yep.
So next up here, we've got mortgage stress, and it's had quite a jump recently, hasn't it, Martin?
Yeah, so this, unfortunately, again, from our surveys, is tracking those households in difficulty. And now it's 31.7%. That's well over 1 million households now. Of course, we know household debt ratios are very high. We know that incomes are under pressure. We know that costs are rising. And we know that many households have mortgages that were way bigger than they should have actually ever had. And of course, recently, the banks reported, and they all reported higher delinquency rates in their mortgage books. So effectively, mortgage stress is looking 2 to 3 years ahead of where delinquencies are. But over time, we're going to see delinquencies rising further as well.
And what's the gap in the bank's measurements? I think their benchmark is around 30%. And what's the difference in their numbers to your numbers of households in stress?
Well, yeah, so the Reserve Bank said around 30% of households have less than 1 month's ability to manage their mortgages. So it's pretty close. Okay. Many of the banks are still not seeing the same risks in the system that I'm seeing. And that's because they don't necessarily have a complete view of the household finances. They only look at it from a loan perspective. But overall, I think more of the lenders are beginning to wake up to the fact that there are higher risks. And in result of that, they're actually reducing the loan to value limits that they're going to lend at, or indeed will not lend at all in some postcodes. So we're seeing a bit of a change in the weather. A bit too late, though, in my view.
Yeah, absolutely. Next up, we've got home prices continuing to grind lower, and this is the core logic data.
Yeah, so this is just a quick summary of where things are as at early May. And, the point to make there is it's Sydney and Melbourne where the major falls from the last peak, which is the sort of bluish bar, has. Overall, of course, though, Perth is actually the worst, close now to 20%. And the overall majors is, across the major five, is now well above 10%. The point here, though, these are averages, right? And so what this doesn't tell you is about the individual property on the individual street. And we know that in many places now, there are areas where prices are 20 to 25% towards 30% down. We know that there are other areas where prices have hardly moved at all. And some of the minor centres like Hobart and Adelaide are still doing better. But even there, it looks as though it's beginning to turn now as well. So unfortunately, the rate of fall, is going to continue. It may slow a little, but I think we're going to see further falls.
So, Martin, in the stock market, we talk about that 20% number as a bear market. Do you think the mainstream narrative is going to jump on board when we see the average or some individual bigger suburbs get to that 20% mark, or how do you see that playing out?
Well, a lot of people are still using the averages and are still saying it's not really very serious. And, the run up in Sydney was much higher than the down. So therefore, what's the problem? The problem is, of course, a lot of people bought in at the top of the market and therefore are now exposed. Negative equity and those things are haunting the halls. But the fact of the matter is that you have to get granular. You have to really understand where the hotspots are. And as soon as you do that, you realise that there are about a third of postcodes around the country now that are really in very difficult circumstances. Around 10% of households have negative equity now. And what that means is that the mortgage is worth more than the value of the property. And that's just another break on the system. So I'm afraid that the mainstream still really haven't caught up here. But slowly but surely, I think people are beginning to understand that this is a big deal.
And this negative equity situation, we know it's different in Australia compared to the US, where you still have your loan even if you default or move out or whatnot. Have we had a situation in Australia where that's happened to any significant extent?
Yeah, so we have full recourse in Australia. In other words, if you sell your property and you pay off the mortgage and it's still not enough to pay off the total mortgage, you still owe that debt, and that debt stays with you whatever you do. Now, the last time around in the GFC, we didn't have very high levels of default. We had some, but not a lot. So we haven't really seen the impact of mass defaults. And the other point to make is that, of course, the mortgages are much bigger these days relative to previously. So the amount you owe is a lot bigger. When you've got $1 million property and the 10% drop, that's $100,000. Whereas in fact, a decade ago, it was much, much lower. And therefore the actual value was much lower. We're going to find, I think, more households are going to be really stuck now. And so they either have to try and hold on and hope that the paper loss actually turns into profit later, maybe 5 to 10 years later, perhaps, or they're going to be forced to sell if they default and then get chased. So I think this is a new situation here in Australia.
Yeah, very unique, I think. I tend to agree. Property sales, so this is the number that's thrown around in the mainstream media as something that's improving when we look at auctions clearance rates, but it's these actual numbers that are important to look at.
Well, that's right. So the clearance rate's above 50%. Yay! No, actually, look at the volume, right? So the volume of sales are way down. This is the CoreLogic data. And this shows you that, firstly, the days on market is going up. It's nearly as high as it's ever been, up at sort of 60 days on average across the capital cities. And the number of settlements is dropping. So these are more leading indicators of trouble in the property market. So I don't see any sign of a recovery correction, in the fall. It's continuing to fall.
And this is very much reminiscent of a conversation I had with my friend who's very deep in the housing market in Melbourne, and he runs his own shop and whatnot. And he was really gobsmacked at what's been happening, telling me, his number of listings is just growing and the number of buyers is just falling off a cliff. So it's a double-edged sword.
In fact, in Sydney, the number of listings are now reducing because people, owner-occupied borrowers owners are now saying no point in trying to sell now. But there's a predominance of property investors who are listing because they've got no choice. They've got to try and get out while they can. So basically, the old adage is, if you're going to panic early.
And those seasonal trends, Martin, we tend to see less auction clearance rates in winter when it's cold and less people going outside and whatnot.
Yeah, so we do. So we have two peaks. We have a peak running up to Christmas and a peak, in and around before Easter, and then it gets a bit quiet over the winter season. So we'd expect, in a normal course of event, for the momentum to ebb further over the winter season. But I suspect this year it'll just continue to go in the same direction, which is that things are going to continue to get a little worse ahead.
Yeah. Next up here, we've got this comparison chart, which you were talking about, comparing the contraction we see in the US during the GFC to Australia currently.
Yeah, so this was quite a neat chart that Steve Keen published the other day, and it just shows the rate of fall here in Australia on average is actually mirroring quite clearly what happened in the US. And I've said consistently that, we are in the pre-financial crisis scenario now a decade later in Australia. But what he also makes the point is if this is anything like true, then we've got a lot further to fall because we're still not following the same trajectory down. The shape is the same, but we haven't come down. So therefore, it looks to me as though this is another evidence point to suggest further falls ahead.
Yeah, and it looks pretty steep when you're just looking at a chart, but this thing does feel like it's playing out in slow motion in the US over that 12 or 18 months, and the same here in Australia, really, doesn't it?
Now, and remember that defaults rose to a peak in 2010 in the US. So it took 3 years for all of the stuff that was there to work through and become visible. So, we shouldn't expect defaults in Australia to suddenly magically rise, but they will continue to grind higher. And I think they'll probably reach a peak in about 3 years.
Yeah. So retail sales, and this is the spillover effect into the economy. We know we're very much a consumer-based economy, and this is trending lower.
Yeah, so we're building towards the next set of CPI data down the track, but retail sales is a good indicator, and unfortunately the retail sales was pretty weak. And if you actually parse it out, you'll discover that there were issues with regard to, for example, discretionary spending, so large household items, they went way down, right? Whereas people are spending more on the necessities, so in things like groceries, because their prices are rising quite quickly, partly because of the drought and partly because, there's just other pressures in the system. But overall, the retail story is actually not very good at all, and it suggests that there's going to be more weakness ahead.
Yeah, I've got some fantastic interviews lined up with Roger Montgomery and Steve Keen to talk about the spill-on effects as well, so I can't wait to dive into that with them.
Yeah, it'll be very interesting. Yeah.
So the final slide I believe we've got here, Martin, is the trade balance. And this is actually a really positive story. So it's important to report the good stuff as well. But Australia's trade surplus remains pretty positive.
Yeah, I thought it was really important. People might get the sense that I only am Mr. Negative, but actually I'm only Mr. Negative because the data's Mr. Negative, right?
Yeah.
The fact is that this is quite a positive story insofar that the GDP looks pretty strong because the iron ore price has been very, very strong. And in fact, we've got a significant trade balance. So, it's positive 4.9 billion in March, which is a really big number. And they also restated the previous one higher too. But it's also reflected on very weak imports. Right. And that's the other side of it. So effectively, what we're doing is we are actually sending a lot of resources out overseas, particularly to China, but we're also importing less because the economic activity inside Australia is slowing. So it's not altogether a good news story, but the net effect is positive for the GDP number. So there may be some good news on the upside from the international perspective, but I'm also expecting some bad news on the consumer side because of the retail and because of the financial confidence we've seen before. So I'm afraid that the GDP is going to probably look pretty weak. I'll be very interested to see what the RBA comes out today with in their updated assessment of the economy and what their projections are for the GDP number ahead.
Yeah, and I love to talk about this with people about Australia patting themselves on the back, and we've been selling so many resources and thinking we're doing really well, but those resources are finite, and if you look at all that wealth that should have been generated, do we really have a lot to show for it?
Well, of course, we are very fortunate because the oil price is very high at the moment, but it's artificially high for all sorts of reasons. It'll come back. That will be a problem. But as you say, we haven't invested for the long term. A decade ago, where we had that mining boom coming through, the wrong decisions were made by the politicians. They gave too much away in tax breaks and all sorts of things. They should have actually invested for the rainy days. And now we've got a rainy day or two or maybe longer coming along, and yet we're really very ill-equipped to deal with it. So unfortunately, we haven't learned the lessons of history.
Yeah, I think it's Norway, Martin, that put in place those sovereign wealth funds to guarantee pensions and whatnot. And would you do something similar if you were in charge?
Absolutely, yeah. So that Norway's got, I think, $1 trillion, equivalent over there, ready because they know that the oil is going to end at some point and they're going to have other things. So they've actually put in place systems and processes to effectively buttress the economy in the bad times. We've done none of that. We just rely on digging more stuff out of the ground and flogging it off as best we can. It's really not a strategy.
Yeah, and this is another thing I spoke to Marin Katusa about, who's a resource investor. He was really passionate about this, and he actually said you can't change stupid. And that's kind of where our politics are at the moment.
You can certainly say that they're very myopic, and they like. Sorry,
you're a popular man, Martin. That's all right.
So you can certainly say they're myopic insofar that they're looking very narrowly. But of course, it's really high risk, and that's the problem. We haven't really built a broad base for our economy. That's what we need to do.
Fantastic. And obviously it is those winter months, so it's going to be very interesting, and we'll keep giving you guys the regular updates. So thanks again for joining us today, Martin.
Good to talk to you.
Thanks, guys.